Welcome back to Iron Financial. This is the channel where we forge stronger portfolios by cutting right through the market's weakness. I'm your lead analyst. Today, we are putting Novartis under some serious pressure. Their latest earnings report is a complete battleground of conflicting signals. You see, you've got this headline beat on earnings, which looks great on the surface. But then you look closer, and you see a miss on revenue that is raising some really serious questions. Now, whenever the market gets a mixed report like this one, it creates confusion, it creates uncertainty, and that is exactly where we find opportunity. Our job today is to stress test the financials, to analyze the structural integrity of this pharma giant, and figure out, once and for all, is this a company building a brand new fortress, or is it one that's starting to show some dangerous cracks in its foundation? Okay, let's get into it.
And hold on right there. That's the core of the whole problem, all on one screen. I'm the market skeptic, and when I see a slide like this, I have to step in and ask the hard questions. Because on one side, you've got the bottom line, right? The earnings per share, coming in at $2.03. And yeah, it beats Wall Street's expectation of $1.99. Now that tells a story of great profitability, of a company that knows how to wring out every last penny and deliver for its shareholders. But then you look to the right. The top line, the revenue, comes in at $13.34 billion. That is a massive $500 million miss from what everyone was expecting. So I have to ask, which is it? Is Novartis this super efficient machine with a rock-solid profit engine? Or is this revenue miss the first tremor before a much bigger earthquake? Is this the first sign that their biggest, most important products are losing ground way faster than anyone thought? That's the contradiction we absolutely have to resolve today.
You're asking the right question, but you're looking in completely the wrong place. The bears, they're going to fixate on that one single number, that Q4 revenue miss, but they're missing the forest for the trees. To see the real strength of Novartis, you've got to pull back your focus and look at the full-year performance. You see, the quarterly numbers, they're just noise. The annual numbers, that's what shows you the real trend. And believe me, the trend is being forged by a new generation of blockbuster drugs. We're calling them the new titans, and they are building this company's future right now. So let's look at the steel frame of these full-year results.
Now just look at this number, 8%. For a company the size of Novartis, growing your top line, your sales, by 8% year over year is, well, it's a monumental achievement. We are talking about a jump from about $50 billion to $54.5 billion in net sales. This is not some small-cap biotech that got one drug approved. This is a global behemoth adding more than $4 billion in new sales in just 1 year. This number tells you that even with all the headwinds from generic competition, the underlying growth engine isn't just running, it's a blast furnace running at absolute full capacity. This right here is the foundation that the entire bull case is built on.
And this right here shows you the second part of the story, and it's all about leverage. You see, it's one thing to grow your sales, it's something else entirely to grow your profits at nearly double that rate. A 14% surge in core operating income tells you this isn't just any growth, it's highly profitable growth. They're not just selling more stuff, they're operating with just incredible efficiency. This efficiency is what led them to a core operating income margin of 40.1% for the entire year. Now get this, the company's own target was to hit 40% by 2027. They didn't just meet it, they blew past that milestone 2 full years ahead of schedule. That is not a sign of weakness. That is a sign of operational mastery and a management team that is executing with absolute precision.
So the most important question is, where is all this powerful, profitable growth actually coming from? Well, it's not magic. It's the result of a very deliberate strategy to focus on a new portfolio of high-value medicines. So let's break down the engines that are driving this incredible performance. I'm about to give you a rapid-fire look at these new titans, the drugs that are quickly becoming the new core of this entire company. You better prepare yourselves because the growth rates that we are about to see are nothing short of explosive.
Okay, first up, Kisqali. 57% growth. Let that sink in. This isn't a rounding error. This is a franchise player hitting its absolute peak. This breast cancer drug is becoming the undisputed standard of care in its field, and it's just gobbling up market share at a staggering pace. You see, its clinical data is just that strong, and its survival benefit is undeniable. This is the kind of asset that becomes a foundational pillar for a pharmaceutical company for the next decade. This isn't just another product. This is a titan in the making.
Next up, Kesimpta for multiple sclerosis, 36% growth. This is critical because it shows that the strength isn't just isolated to one drug. Kesimpta is a high-efficacy B-cell therapy that, and this is the key, patients can administer themselves at home once a month. In a really competitive market, that convenience factor is a huge advantage, and it's driving massive patient demand and strong market access all across the globe. You see, we're seeing a pattern emerge here. dominant drugs in high-need areas with very clear competitive advantages. This is the one-two punch that really defines the new Novartis.
And now just look at this. Scemblix, a treatment for chronic myeloid leukemia with 85% growth. This is what pure acceleration looks like. This drug targets a different mechanism than the older therapies, which is absolutely critical for patients who've become resistant or just can't tolerate the other treatments. It's a game changer for them. The launch momentum here is just incredible, especially as approvals are expanding its use into earlier lines of therapy. So when you see 3 different drugs in 3 completely different areas all posting this kind of growth, you're not looking at a fluke. You're looking at a well-oiled R&D and commercialization machine firing on all cylinders.
Now, percentages are one thing. Let's talk about the hard dollars that are forging this new core. This slide really puts it all into perspective. This is not about small products growing off some tiny base. No. Kisqali is now a nearly $5 billion drug. Kesimpta is over $4.4 billion. Pluvicto, a radioligand therapy for prostate cancer, has absolutely blasted through the $2 billion mark, and Scemblix is well over $1 billion. You add it all up, and these 4 drugs alone added over $5.5 billion in new sales this year. They are doing the heavy lifting. They are forging a new, stronger core for the company that is more than capable of offsetting the decline of those older products. This right here, this is the tangible, hard evidence of the bull case.
And this is the final proof. After all the accounting, after all the expenses have been paid, this is the cash that is left over. A record $17.6 billion in free cash flow for the year. This is the ultimate measure of a company's financial power. This is the money they use to fund the R&D for the next generation of titans, to go out and acquire innovative new companies, to pay out dividends to shareholders, and to buy back their own shares. A company generating this much cash is not a company in trouble. It's a fortress with a deep moat, capable of weathering any storm and funding its own reconstruction. From a bull's perspective, this is the final word. End of story.
A fortress? Maybe. But even the strongest fortress can crumble from within. You know, all that talk about the full year is a nice story, but it's a distraction. It's like looking in the rearview mirror. If you want to know where a company is going, you look at the most recent results, and that's the fourth quarter. And in Q4, the story isn't about new titans rising up. It's about the old guard falling and falling hard. The rot is setting in, and it's being driven by the collapse of former blockbuster drugs that used to be the very foundation of this company. Let's take a look at the damage.
This is the reality the bulls really don't want to talk about. These are not minor declines. This is a cliff. Entresto, once a cardiovascular giant, saw its sales collapse by 45% in a single quarter because generics entered the market. It lost almost $1 billion in quarterly revenue, just gone. Promacta down 63%, Tasigna down 58%. This right here is what the patent cliff actually looks like. It is brutal, and it is absolutely relentless. So for every dollar of new growth they get from Kisqali, they're losing these huge chunks of revenue from their former pillars. So the question is, can they build the new towers fast enough while the old foundation is literally turning to dust beneath them? This table suggests that the decay is accelerating.
And if that revenue collapse doesn't alarm you, this really should. The bulls, they want you to look at the full-year cash flow, but that's history. Look at the trend right now. The net cash flow from operating activities in the fourth quarter of 2024 was a very healthy $4.2 billion. Okay, 1 year later, in the fourth quarter of 2025, it plunged to $2.3 billion. That is a 46% drop. This isn't a crack, it's a chasm opening up in the company's financials in real time. This is the direct result of those falling pillars we just saw. When your high-margin blockbuster drugs fall off a cliff, your cash flow follows right behind them. This is the single most dangerous signal in the entire report.
And hey, don't just take my word for it. Listen to the company itself. This is their own guidance for next year. After bragging about 14% growth in core operating income in 2025, they are now forecasting a decline for 2026. This directly contradicts the entire bull narrative of unstoppable, profitable growth. Management is telling you, in their own words, that the pain from generic competition is not a one-quarter event. No, it's going to hit their profitability for the entire upcoming year. The headwinds are real, they're here right now, and the company itself is bracing for impact.
Okay, the headwinds are absolutely real. No one is denying the impact of generic erosion. But the real question isn't whether there's a storm. The question is, how strong is the ship? A company's true strength, its real structural integrity, is only revealed when it's under pressure. And that's exactly why we have to go beyond the income statement and the cash flow statement. We need to put the balance sheet itself through a stress test. This is where you find out if the foundation is truly solid or if it's over-leveraged and at serious risk. Okay, so before we put this balance sheet through the ringer, we need to talk about the main tool we're going to use for the job, net debt. It's actually pretty simple. You take a company's total financial debt, all of it, and then you subtract all its cash and its cash-like assets. The number you get, that's what gives you a really clear picture of its overall debt burden. It's one of the best and quickest ways to get a read on a company's financial health and its risk profile.
And that's exactly where the next red flag pops up. Just look at the growth in that net debt figure. At the end of 2024, it was sitting at $16.1 billion. You fast forward just 1 year, and it has ballooned to $21.9 billion. That is an increase of $5.8 billion in a single year. You see, the bulls will show you all the cash coming in the front door, but they don't really want you to see the debt that's piling up out back. This is a clear sign of increasing financial strain. Yes, cash is coming in, but the debt burden is getting heavier, and it's getting heavier faster.
But context here is everything. A $22 billion debt figure sounds massive in isolation, but you have to weigh it against the company's asset base. As of the end of 2025, Novartis is sitting on nearly $111 billion in total assets. Their total liabilities, $64.4 billion. That leaves a massive equity foundation of $46.5 billion. So yes, the debt increased, but it is being supported by an enormous and still growing base of assets. This is not a company that's teetering on the edge of insolvency. This is a financial heavyweight with a balance sheet that is built to withstand pressure. That debt is more than well covered.
Covered? Maybe, but the trend is undeniable, and that's what investors should be watching. This final metric, the debt-to-equity ratio, it tells the whole story. It measures how much debt a company is using to finance its assets relative to the value of its shareholders' equity. At the end of 2024, that ratio was 0.67 to 1. Now, it's 0.72 to 1. So while the asset base is, yes, it's huge, the company's leverage is undeniably increasing. The bears would argue this shows the company is having to borrow more and more just to sustain its growth and shareholder returns, while that cash flow from its legacy products erodes. The risk profile is ticking upwards. Period.
All right, we have laid out all the evidence from both sides of the argument. We've seen the powerful bull case, and it's driven by that explosive growth of the new titans and those strong full-year financials. And we've seen the compelling bear case, which is focused on the crumbling old guard, that alarming Q4 cash flow drop, and the rising debt. So the question remains, for an investor looking at Novartis right now, today, is this a strategic opportunity to buy into a transformation, or is it a value trap? It's time to weigh the evidence and deliver the iron financial verdict.
Let's summarize the battle here. The bull case rests on undeniable, explosive growth from its new titans, these products like Kisqali and Kesimpta that are becoming these massive, multi-billion-dollar franchises. And that's all backed up by the strong full-year performance with 8% sales growth and 14% core operating income growth, culminating in a record $17.6 billion in free cash flow. And it's all supported by a massive $111 billion asset base. But the bear case is just as potent. We have former blockbuster drugs literally collapsing under intense generic pressure. That led directly to an alarming 46% drop in Q4 operating cash flow, a truly shocking number. You add to that the company's own negative guidance for 2026 and the fact that net debt climbed by over $5 billion. It is a perfect storm of conflicting data.
So, after weighing all of this evidence, here is our final verdict. Novartis is a fortress under reconstruction. It's not a pristine, finished structure, but it is also not a ruin. I want you to think of it like a massive castle that's undergoing a major renovation. The core structure is sound, but parts of it are being torn down while new, more advanced towers are being erected right in their place.
Exactly. The old walls, Entresto, Promacta, Tasigna, they are crumbling, and they're crumbling faster than a lot of people expected. That's what we're seeing in those Q4 numbers and in that 2026 guidance. It's noisy, it's messy, and it's kicking up a lot of dust and uncertainty. But the new towers, Kisqali, Kesimpta, Pluvicto, Scemblix, they are being built with stronger steel. Their growth is real, and it is spectacular. So the entire investment thesis for Novartis right now hinges on one critical factor: timing. Can they build the new towers high enough and fast enough to bear the full load before those old walls give way completely?
And that is the ultimate question we are leaving you with today. We've shown you the strength of the new steel, and we've shown you the decay in the old stone. The numbers point to a very difficult transition period in the near term, but a potentially much stronger structure in the long term. The answer to whether this is an opportunity or a trap really depends on your time horizon and your tolerance for the risks of this whole reconstruction project. Is Novartis' new pipeline strong enough to rebuild the fortress? That's the question you now have the tools to answer for your own portfolio. Thanks for joining us at Iron Financial.